When trading in Forex, you always need to be aware of what is happening in economies around the world, but you also need to pay attention to commodities such as oil, silver and gold. And this last one especially, because our currencies are all based on it. So in the next few minutes I will tell you about the biggest correlations between Forex pairs and gold and where they exactly come from. Let's get right into the most important correlations between gold and currencies or Forex pairs. So basically I have three correlations, and within those three I will explain to you some broader economic concepts of the relation between gold and certain currencies and certain countries. And certain market mechanics, such as with this one, the US dollar is negatively correlated to gold. And that basically has two reasons which are intertwined with each other. And that's basically that when it is going well in the world, everybody invests in the US dollar, in the companies in the US dollar, the S&P 500, the Nasdaq, everything is going well. So there's a lot of demand for the US dollar, so the US dollar appreciates in value. But when it goes less well, or when it goes wrong in the world economies, everybody will pull their money from these companies, causing the US dollar to fall. And in what will they invest? In safe havens, such as the Japanese yen, but also gold. And that's why it is negatively correlated, because when the US dollar goes up, it's going good in the economy, and so yeah, it goes up. And when it goes bad in the world and in all the economies, then gold will go up and the US dollar will go down. And oh yeah, sorry, I forgot to say, but gold will also go down when it goes well, because everybody will pull their money from gold and invest it into the US dollar. The second important correlation we will talk about is the positive correlation between the Australian dollar against the US dollar and gold. So basically when gold goes up, this Forex pair goes up as well. And that has two reasons. The first one being the one I just told you about the US dollar. The US dollar depreciates in value. So when gold goes up, you can actually get more US dollars for one Australian dollar. But the second reason is that Australia is I think the second biggest producer of gold. So they mine a lot of gold there. So when the price of gold appreciates, the economy of Australia is doing well as well. So again, a reason why you would be able to get more US dollars for one Australian dollar, because the price of gold rises, so you will need to exchange more in order to get one Australian dollar. The last correlation we will talk about is again a negative correlation, and that is the US dollar against the Swiss franc. And that again, as the first reason, is the first correlation. That is, when gold goes up, the US dollar goes down. So when the US dollar goes down, you can get less Swiss francs for one US dollar, and that is why this Forex pair will go down. But there is another reason why this Forex pair will go down, and that is not only the US dollar depreciates, but the Swiss franc also appreciates, because I believe 25 or 20 to 25% of all of the money in Switzerland is actually backed in gold. And that's exceptional for countries around the world. So basically they have a lot of gold and their currency is relatively more backed up against it. And that's why the Swiss franc will also appreciate in value while the US dollar depreciates, causing this currency to go up when gold goes down and to go down when gold goes up.